Hello everyone, welcome to our discussion of inventory in chapter 3 of our textbook. I assume you've already read that chapter and you're ready to kind of highlight those things that are most important. So we're going to jump in here, and when we record inventory, which of course is the things that we buy that we're going to eventually, with the sole purpose of selling to our customers. That's what inventory is. If we are just going to use it, then we usually refer to it as supplies. And sometimes people will say we have an inventory of supplies, but if it's just going to be like things you're going to use in the corporate restroom or something like that, like toilet paper, that's just supplies. Stuff that you're going to actually sell to customers, that's what we call inventory. And so we have to track two things about inventory, because at any given time we want to know if we have the stuff that our customers want. So we need to know how many units, how many baseball gloves, how many basketballs we have in inventory, how many pairs of shoes. But we also, from an accounting standpoint, we track everything in dollars. So we need, and we make all our journal entries and the T accounts in dollars. So we have to know both things at the same time and track them both. So we record inventory at its cost. That includes any cost of shipping to get it to us. Not the shipping to go out to our customers, but the shipping in. So sometimes you'll see the term freight in or shipping in is included in the cost of inventory. So an item that costs us $4 but costs another 50 cents each to ship to us, then the actual cost we're going to end up with in our T account is $4.50 per unit, or however many units we have times that $4.50. Any additional cost to get items ready to sell is also included in the cost of inventory. So if we buy it in bulk, like 50 items, and then we, in a big box, and we split it out and put it in smaller boxes to sell on our shelves, then the cost of those extra boxes that we put them in would be part of our inventory cost. We subtract from that cost any discounts we get for early payment. So when we pay based on, we buy most of our inventory on credit, and if there's a discount for paying within 10 days, like we talked about previously, then we would subtract that amount off of the cost of our inventory. And any items we send back because they're defective or they were the wrong color or anything like that, we send them back to our suppliers, that would be subtracted, obviously, from the cost and the number of units. The discounts will only be subtracted from the cost, the T account, not from the number of units that we're tracking, because it doesn't change the number of units. So the dollars are all tracked, as we said, in the T account, with increases on the debit side because it's an asset and decreases on the credit side. You'll have to use some other way to track the units, not a T account. We're going to learn the perpetual method of inventory. So there's a separate periodic method, but we're not going to spend very much time on that, hardly at all, because perpetual is what most companies use. So every time you buy inventory, every time you pay for inventory, you transport it in, any other costs, are all go in the T account, inventory T account, which makes actually the accounting fairly straightforward as far as where does everything belong. Okay, that T account is being perpetually updated. That's why it's called the perpetual method. Okay, sales of inventory make the T account go down, right? That's at the time of the sale. So every time you buy stuff, you make your inventory T account go up, and every time you sell stuff, it makes it go down. Periodic inventory doesn't do that all the time. It waits till the end of the year and counts up what you have left and figures out what you must have sold, rather than recording cost of goods sold as you go along. that is only used today for very inexpensive items or unimportant items, things you have maybe a whole bunch of, but they don't cost much, like tacks or nails in a hardware store or something like that. Computers make the tracking of inventory perpetually pretty easy. Every time people check out, they're scanning it. That helps update the inventory amounts, both the amounts and the units. Every time, and literally when you buy inventory and put it on your shelf, you can use the same system. Most companies can use the same system to scan it in, just as they do when you check out and they scan it out. Okay, so when you go check out, they scan it. That's telling the computer there's one less of that item on the shelf. FOB, shipping point destination. The idea here is, when do we own inventory? When is it need to be added to our T account? When should it be taken out of the T account for inventory? So there are kind of two conventions. And this is all discussed between the buyer and the seller. There's no set rules. GAAP doesn't say you have to do it one way or the other. It's simply a negotiation between the buyer and seller. The inventory changes hands when, at the point that it's shipped, in FOB shipping point. Okay? So when I put it on the truck to be shipped, that's when it transfers from me, the seller, to the buyer. FOB destination is just the opposite. When I put it on the truck, it's mine the whole way until it gets to the customer at the destination. So it either can change ownership at the shipping point or at the destination. The whole idea is to find the best combination. Customer wants the best combination of paying for the items and paying for shipping. So they're going to look at comparing the price of buying it from me plus getting somebody else to ship it versus buying it from me and having me ship it to them. Okay? So that's important because that's when the T account will be updated. And it works both on the seller side and the buyer side. So if I'm selling inventory, I have the same issue as I do with buying it. I need to know when it becomes ownership so I know when to put it in the T account, when to take it out. All right, this should be review a little bit from earlier accounting classes. In a journal entry or debit credit standpoint, when we sell things, we have two journal entries. One for the sales price, credit sales, debit, either cash or accounts receivable. And second entry is to cost of goods sold, debit, and decrease inventory credit for the cost, what we paid for it. Obviously that should, I guess maybe not always obviously, but that should be different than the sales price. So the first entry should be for a higher amount than for the second entry. That's the whole point of us being in business, is to sell our stuff for more than we paid for it. This happens with every sale, every time we scan it, every time the transaction happens. It's go on the T accounts and we track the inventory units separately. In a computerized environment, it can be done in the same system, but it's still like in different columns. And then kind of an overall inventory formula says that we can always kind of check ourselves by looking at the beginning inventory plus what we bought minus what we have left over equals what we sold. The problem with that at the end of the year is that cost of goods sold includes anything we may have been missing for any reason. It may not have been sold, it may have been damaged, it may have been broken, it may have been lost, any of those things, and it still ends up being all lumped in one calculation. So, just because we use a perpetual method, just because that everything should be tracked, every time you sell something, It should reduce your inventory. Everything you buy should make it go up. It should be constantly updated. At any time, we should be able to look at the T account and it should match what we have on our shelves. However, even under those circumstances, even when we have a good system going, we probably want to count at the end of the year because we may have missed some things. There may have been damaged items, stolen items, lost items that were not updated in our T account or in our units. So we take a count. We actually physically count the items. That may indicate a discrepancy between what we count and what our records say based on being constantly updated. If that's the case, most likely we're going to need to credit inventory, make inventory go down to what it actually is, what we see on with our two eyes, count up, and debit cost of goods sold. Okay? So that lost inventory is treated in this situation like it was sold with no sales price. Now, occasionally you may have counted inventory and there may be more than what your system said. That would mean that you missed a purchase of inventory, didn't put it into inventory when it came in. Got all your sales right, but you forgot to bring in something. That's less common, but it happens. It could happen that you need to debit inventory, make it go up, and credit cost of goods sold, but much less likely. So when we calculate cost of goods sold, when we move our inventory from inventory, we credit inventory and debit cost of goods sold, we need to know the amount, right? It has to be a dollar amount. We know what the units are. That's easy to see and observe. If we're standing there, we can see how many units were taken out of inventory and put in boxes and shipped off. Okay? But the problem is, what cost per unit should I use? Okay, what cost should I use? If I can tell exactly, meaning each item has a unique serial number, then I can, when I sell my item, I can look it up and know exactly what I paid for it when I bought it. If that's the case, that's what I should use when I sell it. I should use that cost to move from inventory to cost of goods sold. If all the units in inventory cost the same number, same amount per unit, then I just need to know how many I sold and multiply it by the cost per unit. Easy. But what happens if I have inventory in my units that have different costs? Say I bought some at the beginning of the month for $4 and some at the end of the month for $4.25. Could have been an increase in price, could have been an increase in shipping costs, could have been whatever made that change in between what we bought at the beginning and what we bought at the end. When I go to sell that, what should I use? The $4 or the $4.25? We can't tell the difference. We'll assume that these items are all the same color, same size, whatever, and therefore there's no way to tell the difference. So you're going to have to make an assumption as to which ones it is. So we have three cost flow assumptions: first in, first out, last in, first out, and weighted average. So first in, first out, or FIFO, we are going to assume we sold the oldest units, the ones we bought at the beginning of the month or the ones that were left over from last accounting period. Okay? That means the newest ones, the ones we bought most recently at the end of the month, are assumed to still be in inventory. This is an assumption because we cannot tell from looking at them which ones we're selling. All right? This probably is what our assumption would be most likely. As we think that physically the units would be rotated. We want to sell our old units first. But let's be honest, you cannot tell, you do not know. Let's say they're water bottles. There is no way to tell which ones they were. It could have been shifted around on the shelves or whatever. So we're making an assumption. The other assumption is LIFO, last in, first out. This is the newest items are assumed to be sold first. With LIFO, you have to pay very close attention to the dates, because if you sold something on the 25th of the month, the newest items that you bought could have been the ones on the 23rd, but they can't be the ones on the 27th. That hasn't happened yet, because you're selling them on the 25th. Okay? With FIFO, you don't have to be so particular. You can just need to know generally which ones are old or new. But with LIFO, the amount of new ones change, which one's the newest ones changes every time you buy something. All right? So that means the oldest items are still in inventory, is what you assume. Again, no doesn't have to match what's actually physically happening on with our inventory. Weighted average, okay, tries to add up and average all of the costs together. All right, so it looks at what the balance is in the T account, what our total was, divides it by the number of units, and gets a weighted average times the number of units. Okay, so how do companies choose which one? Okay, GAAP says you can choose whichever one you want. You do not have to pick one. I mean, you do have to pick one, I should say, and you need to stick with it. That's what GAAP says. It does not pick it for you. It does not tell you which one to do. All right? So when prices are rising, LIFO uses a higher cost for sales of inventory and then increases cost of goods sold and decreases net income, which is good for postponing taxes, but not for looking good as far as profits or net income. When prices are falling, it would be opposite. FIFO would use the higher costs, okay, and then increase costs of goods sold and decrease net income. So it depends on what you think as far as falling and rising prices, but remember, you don't get to choose one each year. You got to pick one and stick with it. So you're stuck with the advantages and the disadvantages regardless of whether the prices are rising or falling. Okay, you can't just choose back and forth. And then the last concept has to do with the cost of our inventory. Remember, we record the cost. We put it in the T account when we buy it at its cost. Now, of course, our assumption when we bought our inventory was that we were going to sell it for significantly more than what we paid for it. Okay? But sometimes things happen to that inventory. Maybe competition comes out with something much better. Maybe it just gets old. It sits on our shelves too long. Maybe it's just a color that everybody thinks is heinous. We thought looked really cool and nobody likes it. Okay? It may still be worth something. I mean, sometimes your inventory becomes worthless and you're just going to throw it in the garbage. And you would take the cost of that inventory, you throw it in the garbage, and move it to cost of goods sold, credit the inventory and debit cost of goods sold. Okay? But some things can be sold clearance price or some kind of an outlet store like Ollie's Bargain Outlet or something. Okay? And when the amount we can get for that inventory, we have to estimate that at the end of the year. If we think that this inventory we still have, we haven't sold it yet, if we look at it and we say, I don't think we're going to be able to sell it for the regular price. In fact, we're not going to be able to sell it for anywhere close to the regular price. We think the best we're going to get for it is a dollar amount that's less than we actually paid for it. That's what we call the net realizable value. That's what we can sell it for minus any costs we need to get it to the customer. If that goes below the cost, then we need to make an adjustment. Even though the items haven't sold yet, we need to look at that and say, being conservative, looking at the worst possible scenario, is that we're going to sell this later at a loss, for less than what we paid for it. Since we already know that, we're going to estimate that amount and we're going to record that loss by debiting cost of goods sold and crediting inventory for that amount of the loss. Okay? So we're anticipating a loss. We never do that with gains, right? Because we're always going to err on the side of making us look worse. But we do this when we have a loss, when there's evidence that this inventory is just not selling, and therefore we're going to have to sell it. To get rid of it, we're going to have to sell it for way below what we thought we were going to sell it for, and even below its cost. If it's a discount from the regular sales price, but it's still above the cost, we don't have to worry about it. It's only when that net realizable value goes below the cost that we have to make this anticipated loss journal entry. So that's the idea. On our part 2 video, we're going to work through an example of how we would do that using the T accounts.